Any of those three things is fine with me as long as we're getting paid. I don't care if I get paid through a dividend. I don't care if I get paid through shareholder buybacks. I don't care if I get paid through them keeping the money and doing neither of the first two things and just having more appreciation in the underlying asset. Luke says, hey, Derek, good to be here again. Glad to hear more insights from you. My question regarding the markets this week is that I noticed when analyzing a financial institution that its book value was much higher than the standard accepted range. But when I dug a little deeper and compared it to numerous competitors, it seemed fairly common for book value of 2.5 to 5 to appear. Is this typical? And if so, what ratio would you consider to be undervalued in that industry? I don't buy financial institutions during normal times. I might buy, in the past, I've owned Chase. I've owned stock in Wells Fargo. So Chase is JP Morgan. So JP Morgan, Wells Fargo, Capital One. I made money with Capital One. That was nice. What else? American Express, if you want to call that a financial institution, Fifth Third Bank. But I bought those at a time where things are so distressed, they couldn't help but do better. And a lot of them went up, 40 to 60% in a couple months, I think. Some of them weeks. Some of them were a couple months. I bought those in 2020. I think I sold a lot of those also in 2020 because I thought there were better opportunities after they ran up, 30, 40, 50, 60%. I remember selling calls on Capital One. I think Capital One got called away from me, but which I made good money on it. I was happy. I mean, I wouldn't have sold the calls at that price if I wasn't happy to sell it at that price. But the honest answer to your question is like, yeah, I don't know. There's plenty of things I don't know. Take a look at it yourself and see how you feel about it. But at the time that I was buying those, I made good money on it. But the bet was not like, how does this one compare to its book value? The bet was these are so abused and so fucked up that any good news is going to make them pop. And they did. And, I thought of them as a short-term investment more than a long-term investment because there are still going to be other things that were distressed that were a better long-term investment. So I had enough information to feel confident with the decision that I was making, but I didn't have 100% information, including a great thesis on what book value should be in various points in an economy. Good question, though. Nothing wrong with your question. Good question. Guy says, hey, Derek, what is your opinion on investing in mature companies that do not offer the best appreciation potential, but are very low risk due to their high fundamental value and can offer good dividend payments? I think dividends are overrated. I don't have any, first of all, there's nothing wrong with what you're saying. If you don't mind a mediocre return, if you don't mind, smaller returns, you can invest in companies that are more stable, slow growth, or no growth, but have a dividend. So it might be zero growth, but have a dividend. But just a comment about dividends in general, that there's nothing wrong with dividends, but if you can get a shareholder distribution / dividend, / return of capital, they call it different things. If it's a C corporation versus a multi-limited partnership, they would call it return of capital. The REITs, they call it, shareholder distribution, I think. Nothing wrong with having, I'll just loosely say dividend. But, if they kept the money and reinvested it, what would the rate of return be? And if they could keep the money and reinvest it for a higher percentage rate of return than you're getting on the dividend distribution, then wouldn't you rather they kept the money and made you even more money with it? Because when they give you the money, first you got to pay taxes on it, then you got to figure out what to do with it. So if they just held it, nothing wrong with dividends. If you want it to, especially if you're old and you want it for your retirement, that's great. I like dividends. I get paid, I don't know, over $100,000 a month, I think, in dividends and from various companies, dividends / other payouts that I just described. Nothing wrong with that. But what I'd like even better is, what if they just kept the money and, if they could give me a higher rate, if I was getting a 7% dividend or a 10% dividend, but the company could keep the money and have a 15% growth rate, Well, I guess I'd rather that they were just kept the money and I didn't pay taxes on the 7% dividend and the stock price would go up instead. So when you're getting a dividend, you're getting that distribution, at the cost of a lower stock price. If they would have kept the money, it would have gone up. Now, there's a counter argument, however, that some people buy stocks because they like the dividends, and they'll bid up the price of a stock because of the distribution. So, there's a counter argument like that. A third way that a company can pay you back is through share repurchases, buying their own shares off the market, which creates less shares available. So for people who want to own the company, the stock price goes up when there's less shares, and the company is absorbing some of the shares back, buying the shares from the people who want it least. Then they're rewarding the people who want it most by driving up the prices. So any of those three things is fine with me as long as we're getting paid. I don't care if I get paid through a dividend. I don't care if I get paid through shareholder buybacks. I don't care if I get paid through them keeping the money and doing neither of the first two things and just having more appreciation in the underlying asset and my equity in the asset. I'm pretty neutral, but if you have a preference, if you want to live off of the money, then dividends are great. And other than that, I'm quite neutral. I don't need to live off of the money. I just go reinvest it. So I'm neutral between the three. So any of those is good by me. And then, back to the first point of your question of slower growth companies or no growth companies. I mean, if you want to, I like to buy things that are out of favor and going to do better in the future, I think. But I don't know. I think it's safer to do that. You just have to be patient with your timing. But you can do whatever you want. That's what you're here for. Some people are confused. They say, Derek, what is the 10 Commandments of Wealth? Not the 10 maybes of wealth. It's the 10 core things that you're going to need to know about in detail if you'd like to accumulate significant wealth in your lifetime. Click this link up here to find more information exactly what is the 10 Commandments of Wealth, how is the program structured, what's inside of it, how are you going to benefit from it. If you're doing well already and you'd like to do better, click that link and find out more. There's over 100 hours of content in this program. I've interviewed dozens of world champions that shared what it took for them to win, to be the top Hall of Fame athletes in their respective areas. And I brought a lot of other superstars in there from business, people that are real world entrepreneurs that made serious money, as I have myself. We all share with you what are the foundations you're going to need to know if you want to be successful yourself. Be a chooser, not a loser. Leave a comment if you want a business or success question answered, and subscribe for even more winning.